Well, good afternoon. Good afternoon and welcome to another of our webinar Wednesdays. Here we are back for Managing Your Small Business Beyond the Pandemic, number 83. It started back on March the 18th, 2020. Good afternoon, I'm your host and SBDC Director for the California State Bakersfield Small Business Development Center. And I will be your host today. Got a great guest speaker today that's not up there for, I don't know why. But we do have Michael Balstad with Harvest Transition Solutions, and going to be talking a lot about exit strategies and some great things coming up. So what are we going to get into today? What's up today? October the 6th. Well, right now it is still a lot about EIDL. We've been talking about the Economic Injury Disaster Loan Program for several weeks, knowing that there's going to be changes that are coming up. There's still that window open until October 8th for you to get your EIDL in that's under $500,000 and receive preference. After October 8th, all bets are off. The big guys can come rolling in. You could see EIDLs for certain businesses that go up to $10 million. So we're going to talk a little bit about EIDL. We're going to talk about, no vote actually happening and no ending date on the ERC. We thought we were going to get a vote last week and it didn't happen. The California Relief Grant closed last week. You should check your email, see if you got something from Lindustry. They have been backfilling and funding previous applications. So even if you were waitlisted from, say, January or February, there's still a chance here in October you could actually get funded for the California Relief Grant. We'll have some tips for EIDL, and just our biggest for the California Relief Grant, our tip is going to be to continue to look for your email. And if you get an email from Lindustry, there is action that needs to happen. You need to provide additional information for them to provide you an actual relief check in the amount of $5,000, $15,000, or $25,000. In a little bit, we'll have with you some great tips for those that are transitioning their businesses. And really, it's something that I think a lot of us, at least in this community, have seen. We've seen it since the onset of the pandemic. We have some great examples. One of our favorite local all-time oldest restaurants in town, Noriega's, great Basque food that dates back decades and decades and decades, announced they were closing at the beginning, basically in April of 2020, at the beginning of the pandemic. And what did we see that they did was they essentially said they were going to sell their assets and they were closing the doors. And then what did we see? We saw a public support for that particular business jump up and said, no, you can't go away. We really want you. And what happened was they were able to find businesses that were for sale and actually sell their particular business to an interested party that came out of the community. And now we have, since June of 2021, we do have Noriega still in a different location, but still functioning here in town. And, I think what our guest speaker, Michael Balstad, will get into in a little bit, is that is happening pretty much everywhere, where you're seeing business people that are wanting to transition either to retirement or the next phase of their life. And maybe they're not making as great a choice as they can about their business and transitioning away and exiting that business without a better strategy. So we're also going to take your questions. Smoke's got me a little bit today, so you're going to get my crappy Kelly voice today, and we get a poll. So let's go to the poll. So our poll question today is going to be, and I'll launch the poll. It's tied in with today's program. So today's poll question is, what percentage of businesses for sale actually sell? Is it 20, 40, 60, or 80%? So kind of our pop quiz question today, you tell us, is it going to be 20% of small businesses actually sell? Is it going to be 40%, 60%, or 80%? So jump in, and we're getting up to about 62% of you that have participated, almost over 72% now. So what we're going to do is we're going to jump jump in and close the particular poll. Last chance to get in. You can get it over 80% participating. One more. Too late. Okay, we got 79% of you that participated. That could have been a record, you know. Usually we're in the 60s. So 79% to the question of what percentage of businesses actually sell. And here's what you said. 41% of you said 20%, 32% said 40%, 18% of you, 60%, and 9% of you, 80% actually sell. Well, I'll let Michael give the details later, but I'll tell you, it is right. You are right this week. 41% of you, 20% of businesses for sale actually do sell. So we'll get some great tips on improving that statistic as we move on and kind of get back with where we were. So thank you for participating in the poll today. Just kind of a heads up of what's happening on the next few weeks of Webinar Wednesday. Next week, there will be no guest. It's our once a month deep dive into a lot of what is happening and a lot of what is happening in a lot of the pandemic relief programs. So if you have any questions, if you haven't gone through PPP forgiveness, if you're still looking at EIDL and still looking at potentially getting in, next week we'll know if there's been that big massive hit that we're anticipating in the EIDL program that maybe ends it or not. So that's coming up next week. The following week, our guest is going to be Megan Hodat with the Small Business Finance Center with the iBank, which is the program of the Governor's Office of Business and Economic Development, and Infrastructure and Economic Development Bank. And then we're going to get into the ERC, the Employment Tax Credit, with number 85 with our special guest, Michael Stevenson from the CPA locally. So just kind of remember when we'd have like 15 items on this page? Kind of the status and action of our key stimulus programs. Boy, this page is going to be gone before much longer. But you still have 2 days to get in on EIDL. And we're going to go over that and spend still some time. So for those that still want to apply, you want to go through a reconsideration if you were previously denied. There's been so many significant changes to EIDL that you really need to consider, even if you were turned down last year, going through the reconsideration process. The EIDL loan was an emergency funding program for working capital. Last month, the EIDL program changed and it is getting much larger, more uses of funds to where it is now a recovery tool for businesses. And we'll get into a few of those things briefly before we bring in our guest. The Employee Retention Tax Credit is open and officially it still ends the end of this year, as is the EIDL programs for targeted advance, supplemental advance. The California Relief Grant Program ended on actually the 30th of September, but I left it as open because you still can receive an email and you still can get funded, but it is not accepting any new applications at this time. And we'll talk more on PPP forgiveness next week, but really you have 10 months from the end of your covered period before you will actually get an invoice. You have a longer time than that to actually get your PPP forgiveness in, but if it doesn't get in, it is not forgiven. So you can go from basically the PPP forgiveness process grants you the money to actually paying it back by not going through that process. So a little one pager that we did and continue to share with everybody on the changes for the EIDL program. As you know, the cap increased from $500,000 to $2 million. The deferred payment period still is there to where we're still working on a deferment and it still is going to be into next year and potentially even longer before you have to start paying it back. That 30-day exclusionary window is now a 2-day exclusionary window. So you have today and tomorrow, and then loans over $500,000 will be considered. The SBA has already received them. They can start funding those or approving those as early as Friday, October the 8th. The great thing about this program and why I continue to talk about it so much is that you can now even take out commercial debt payments. So if you went to an online lender and got a 57% loan not that long ago, you can actually now go in and get a 30-year 3.75% loan and pay it off. You can pay off non-federal debt. That's all changed. This is a great opportunity for you to reset your debt schedules and to make differences that are going to hit right to your bottom line, right to the cash flow aspect of your business. It hits your net profit. So I'm passionate about it. I really like the EIDL program since day one. I know you guys know that have been around for some of these 82 weeks, but still, with those changes, it even makes it even greater. So what you need to do is you need to do a few different things. You can actually go to the website, and Maureen will be filling the chat up with some of these links. There'll be links in there for EIDL to apply. There'll be links on to request reconsideration. Reconsideration, if you were denied 2 years ago, do not go through that particular process again to where you actually put another of your employer identification numbers in the portal. It will just cause you even more delays than what we're seeing still. So, and then there's some other links. I'm sure that this one pager will be in the chat where you can grab it. Some FAQs. Always a resource is the customer service number, the 800 number, the toll-free number. That is the SBA's disaster loan portal. If you have a question, first resource should be with them. If you want to go back and go to our YouTube, and you could watch, I believe it was webinar number 80, back on September 22nd with Keith Bryce and myself talking about all of the EIDL changes for a full basic hour. It's great to play at 3 o'clock in the morning when you need to go back to sleep. So just real quickly on the EIDL numbers, we've been following the EIDL numbers on the SBA website. As of last week, when they last updated it, there's been $270 billion that has been spent in EIDL. We believe that there's close to about 500 billion, which would leave, once the $2 million start coming in for that EIDL, about 100,000 businesses that haven't been able to access it can jump in and get in then. We know that EIDL funds are in part of the Senate $1.1 trillion infrastructure bill. I think last week this slide said the House is expected to vote on it tomorrow. I think this is the best way to do it now. And I'm going to go back to this. The House is expected to vote on it someday. But the key word there is someday and expected. So right now, what that means with EIDL funding is that there's still $30 billion more in EIDL as long as that happens. Not really going to go through many of these EIDL changes because I want to get our guest speaker on quicker. We do know that the EIDL program was increased to 500,000 in March 2020, and then it's going to $2 million in 2 days. So there again is at great terms that you can get with that and more uses than you first had. You could have been declined. The credit scoring is easier. There's a lot of reasons to go back and visit it as soon as you can if you think you have any needs for these monies. When we started out, we thought that, we already heard the PPP was an 8-week program, that we were going to be impacted 8 weeks. We're now into this over 18 months. So please keep that in mind. I don't see a lot of pandemic relief coming down the road for small businesses anytime soon. Maybe we don't need it, but there might be a time if this lingers and continues, businesses bounce back slowly, that we might need that. There's where you go to actually request additional funds. The easiest way is to go into your portal, check the green box, move the slide bar from whatever loan you have right now up to what you think you need, and then click the button to request additional funds. Again, if you get this in before midnight tomorrow night, it'll be considered and put ahead, I believe, of those. I'm assuming it'll be a place held in line. We'll see. Maybe they are going off approvals, but that'll be the great thing that we learn next week. So there's your request an additional increase into your economic injury disaster loan. You know, there's a couple of fixes. This was one of the problems that we studied for quite some time, and unverifiable information. And really, we're seeing it still with people that have different addresses on their tax returns from their mailing address. So all of your information needs to be consistent if you're doing a new application in the next 2 days, or if you're just looking at potentially getting an increase. And there's our biggest part of our EIDL issues. Again, more uses that you can use it for rather than working capital needs, which were happening to begin with. Some of the issues, and we'll touch on these a little bit more next week, that you will need is hazard insurance and some things like a corporate resolution to borrow if you're a corporation. They might even want to see your corporate minutes. Employee retention tax credit, not a lot has changed. We're going to be covering that in a few more weeks. So as I continue to blow through a lot of this stuff, we'll have more, but it really comes down to managing pandemic relief. And really, each individual client that we talk to, each attendee on this webinar, you all have unique situations. And what you need to do is look at your situation. Maybe you want to retire. Maybe you want to retire after today, or you wanted to retire 18 months ago. We'll get into that situation next. But you need to know your timelines and understand what you can use your funds for. You don't want to be using any of your funds for multiple programs, such as the California Relief Grant or a PPP second draw. And always by doing this, you can maximize your expenditures and maximize your benefit from these programs, which give you a greater chance of survival and actually growing outside of this pandemic now. So that brings us to today's special guest and today's program. And Michael Balstad, he is the founder of Harvest Transition Solutions, a firm that specializes in exit strategies for small business owners wanting to sell or transition past being a small business owner. He's a certified exit planner. We're going to talk a lot about these smooth transitions into retirement or another phase of their business life. He has mentioned that 80% of businesses for sale do not end in a positive transaction, and we'll be able to talk to that. Great resource to have, great topic today. Michael, thank you for joining us. Take it away, please.
All right, thank you so much, Kelly, and thank you everybody for being here today. I'm going to go ahead and share my screen. And so, as you mentioned, I'm a certified exit planning advisor. I've worked with a number of the SBDCs across California and a couple of other states over the last few years. And if you were to go to my website, you'll see a phrase on there that says, "Is your biz leavable?" And really, I coined that phrase because the biggest reason that 80% of businesses listed for sale and 70% of businesses that are family enterprises don't make it beyond the founding owner. And it's precisely because they're not leavable. The current owner either is the business or wears all the hats, such that if they were to leave, or if something were to happen such that they became ill and were incapacitated or unfortunately passed away, business could not survive without them. And so really that's what I've gotten to with the programs I've done with SBDCs and other organizations, and really working with my own clients. And so we have three objectives at Harvest. The first is helping owners and their advisors to successfully navigate what may be the most impactful set of business decisions they'll ever face. I liken it to taking off in a rocket. When they just had that launch recently where Richard Branson went into space. Taking off was exciting. They all celebrated that, but you know darn well that in advance they had prepared for how they were going to land that spaceship, because until those people were safely on the ground, that flight wouldn't have been a success. Likewise, when you start a business, possibly you have a good idea, and if you survive past that startup phase, that over the first 15 years, 90% of startups will fail. So if you're lucky enough to be the 10% that survive that, the lack of planning and preparing in advance leads 80% of those surviving not to make it. So my focus with my personal clients that I work with is to help them align their decision-making with what they ultimately would like to see in their lives, in their life after business. Second objective that I have is to develop tools and collaborative resources to assist other advisors and organizations like SBDCs and some of the other technical assistance organizations to be able to deliver these same services to the small business community. And thirdly is to create opportunities for a new generation of entrepreneurs to go into business prepared for success. And the reason this is important, for those of you who have been in business for any period of time and for whom this seemed like it would be a timely topic, you found the secret recipe. Now, as I mentioned, most businesses fail in that startup period. And what you have of value is that you've already done the heavy lifting. And positioned correctly, that's of value to someone wanting to go into business, because acquiring a business like yours that's successful is a much lower risk way to get into business than starting one from scratch. So in helping mature business owners be able to exit their business and that business surviving in the hands of a new generation winds up having us have an ecosystem of small businesses that survive generation after generation, which would give us a much more stable economy, makes jobs much more stable, and it benefits everyone. So one of the things that a lot of folks want to know when they're wanting to get out of their business is, for those that want to sell it, they want to have an idea of what their business is worth. Tell you why this is a topic of conversation right now. With the 80% failure rate of folks exiting their business, there are a number of individual causes. I will tell you they all boil down to one thing, and that's a lack of communication. And oftentimes that lack of communication is brought on by procrastination. None of us want to think about our mortality. We don't want to think about getting older. And for many of us, I'm a small business owner as well, we work in the business 60 hours a week. We wake up at night worried about payroll and having those other concerns. The business is in our life, and in many cases, it's our identity. So the last thing we want to think about is, what happens next? Or is there anyone here that would be able to take the business over? Or do I want to share with others that I'm thinking about exiting? There's a lot of these fears that drive procrastination. And about 50% of business owners right now are over the age of 50. So within a decade and a half of what would be a normal retirement age. So we're talking about roughly 12 million businesses in the US that are affected by this. So we've had this period of time where people have not been addressing the need for an exit. They don't think about it. In fact, in one survey where it asked people about their timeline when they wanted to get out, 10% of the respondents said that they don't ever plan to leave their business. And unless they know a secret, I'm pretty sure everybody's going to leave this world and their business at some point. The question is whether it will be by design or by default. So what's happened since the pandemic, though, is most businesses, well, I would say all businesses have had some impact from it. The majority have had some form of a negative impact. Anything from being forced to close, and yet when you're forced to close, you still have bills to pay, you still have employees to be concerned with, leases of your locations, and a lot of people are just tired. And so what started to happen around the beginning of the year is I started to get a lot of calls from around the region I serve up in Northern California, folks that just want to get out right now. So suddenly folks went from not thinking about it at all to my exit is yesterday, if that's possible, just because of stress and sometimes physical health issues, sometimes mental health issues. But what ends up happening there is that now the value of a business becomes very important, because if you're going to go on the market, much like real estate, it's important to know not only what you could sell your business for, but also what you get to keep, from a tax standpoint. So I wanted to share a little bit about the last quarter, second quarter, what kind of happened in the marketplace. So the median price of businesses in the country came in at $320,000. Now, that was a 19% increase in price from the second quarter of 2019. Yes, The second quarter of 2019 was before the pandemic. So it might sound surprising that the prices were higher this last quarter than 2 years ago when we had a stronger economy and a lot less uncertainty. Something else that was true is that there were 38% more businesses sold in second quarter of 2021 than 2020. Now that would seem to make sense since the economy was shut down and people probably weren't of a mindset of wanting to buy a business because no one knew what was going to happen. But the thing that was very interesting is that the number of businesses sold since the second quarter compared to 2019 is that there were 16% fewer businesses. So more businesses or fewer businesses sold than 2019, but at a higher price. So when you think about that, that would really probably indicate that people are flying to quality. They're recognizing that after this stress test that the economy had on businesses, that it matters how a business is run if you want to own it, because that comes back to that resilience question. So then sales prices, 81% of businesses sold were under $1 million, 19% were over $1 million. And from a geography standpoint, 46% of buyers were within the county they reside in. 32% were out-of-state buyers or out-of-county buyers, and 22% out-of-state. So it also helps you to think that there's a good chance that you may want to think about how you would be found by out-of-area buyers when you're looking at selling your business. So the median number of days on the market is 185 days or 6 months. The average price is 2.5 times cash flow. So these are for businesses under $1 million. So what that would mean is, let's say that you're a sole proprietor and your seller's discretionary earnings, the amount that you got to keep was $100,000. Well, with that median multiple, that would mean that that business would have sold for about $254,000. Or 2/3 of revenue was another comparison. But that's not the whole story. As we said before, 8 in 10 owners who attempt to sell fail to do so. And of those that do, nearly half will have to make concessions on price, terms, or both. And by terms, I mean things like maybe the buyer will need the seller to carry a note so that they're maybe tied to the business for a little longer because they're accepting payments. So you're, possibly going to be relying on the continued success of that business under the buyer's ownership. So if the business isn't as strong, the buyers can be able to negotiate some of their own terms as well. So why is this? Well, there are 3 things that come into play for a successful exit. If you think about a stool, a 3-legged stool, which of the 3 legs is more important? As an illustration, all 3 are equally important. If one is shorter, you're going to slide off of it. If one is weaker and it breaks, you're going to fall over. In exit planning, the 3 things that are legs of the stool are personal readiness, that is life after business. That is, what you're going to do later. And for most of you, at least in my experience, I don't want to presume for you, but in my experience in the speaking engagements I've had over the last many years and the hundreds of businesses I've worked with, the last thing on their mind is what's happening later. Unless they are the ones that are truly prepared and they've got to, that the business isn't reliant on them, because they have so many competing demands that a lot of those concerns get kicked down the road a bit. So the proof in the pudding is there was a survey done where they asked business owners who had successfully left their business. One of the questions had to do with post-business life satisfaction. 75% of the respondents indicated in a multiple choice list that they profoundly regretted it within 12 months. And if they had a successful exit, that indicates that they probably got what they needed out of the business financially. In many cases, this is because they had nothing to look forward to. There's only so many cruises that you're going to go on. There's only so many rounds of golf before you're saying, is this all there is? So the importance of having an eye towards what life after business would look like, what that next act will be, is very important. The second leg is financial readiness. And that is the looking at, once you leave your business, will you have enough resources to meet your future financial needs? Oftentimes what you would do is, if I'm coordinating with my clients, other advisors, what we're wanting to know is what that future financial need is. Financial advisors generally going to come up with something called the financial needs analysis. That's going to indicate a combination of income and assets that would be needed by a person to last throughout the rest of their life. So in comparing that with what a business owner has outside their business already, that there would be a gap. And whatever that financial gap is what you would need to make up from the net proceeds from your business. So if you had $1 million need and you had $500,000 outside your business, that would indicate that you would have to net $500,000 after tax from your sale to have that standard of living that you want after you exit your business. If your business isn't worth that much, then you'll be needing to do things to grow value in that business. And if it seems that it would take longer than you want to continue to work, then you would have to start making decisions on, okay, well, of all of these like to haves, I might have to accept some got to haves and give up or sacrifice some of those things that would be nice to have over time. The third leg is business readiness or business attractiveness. What's important about this is that it is how attractive your business would be to a potential buyer. This goes for any of you who are looking to transfer to a family member or maybe an employee, because the perception is what creates value. So it doesn't necessarily mean that you're going to sell the business. So the idea is this: a person buying a business is buying one thing and one thing only. They're buying the future earning potential of that business. Now, the premium or discount they're going to be willing to pay for that is going to be inversely related to the amount of risk they perceive in the business. In other words, if it's just as risky to buy this business than to start one from scratch, why would I spend the extra money to buy it? So the better that an owner does in preparing their business to be attractive, focusing on 4 areas that I'll share with you that drive value in a business, the more that it will be worth to those potential buyers or to the banks that are going to need to finance a transaction for your employees or your family members. So in this, with what is an exit plan, you're going to have the 3-legged stool that considers those 3 things so that you can look at what is your personal vision of when and how you will exit the business. You might say, you know what, I'm going to leave it to my kids and I'm going to go off on a boat and write the next great American novel. Or you might say, I'm in a small community and it's really important to me that this business stays in the community because it's a major provider of employment. Your different priorities are going to indicate what would be the appropriate type of exit strategy that you would use. Your vision for what your life looks like after is going to determine the amount of financial resources you would need to derive from that. Then you're going to look at ways to develop value creation and growth such that the business will be worth what you need it to be worth at the time you want to leave. Then you're going to look at the best tax planning, wealth planning, and risk strategies to put into place to consider that. So in other words, you might say, well, my business is worth $1 million. That's great. Well, it doesn't matter what your business sells for. It matters what you get to keep from that. So there's importance of working with your tax professional so that you understand what your cost basis is and so that you have a well-rounded understanding of what kind of tax liability would happen from a straight sale, and also what other ways you might be able to execute a transition that might mitigate some of those potential tax liabilities. And then finally, like I had mentioned early on, to consider life after exit, what it could look like, and whether you are personally prepared. So I have a quote below by someone by the name of Peter Chrisman. Peter Chrisman was a very successful investment banker. He actually founded the Exit Planning Institute, where I got my designation, and he's the one who coined the phrase exit planning. And he said, everyone is going to exit his or her business. It's just a matter of how and when. And again, I would add to that, whether it's by design or by default, whether you're going to get what you need out of it or whether you're going to be at the mercy of what you get out of it. So Peter, he's still with us today. He's just retired. He wrote a book called The $10 Trillion Opportunity. And the whole reason that he came up with this idea of exit planning is he was very successful at helping folks sell their businesses and helping them to get top dollar. But what he began to notice over time was that these folks weren't happy. They got all the money that they wanted, but they weren't happy. And that brought in this life after business discussion. They just went from having purpose. We thrive when we have purpose. We thrived when we started our business, we had a purpose. We weren't making any money probably. The fuel we had was our passion. And eventually that passion turned into momentum with the product or service that we were offering. We gained clients. It was contagious. Suddenly we have a success. But then that business becomes our identity. It becomes what we spend most of our time doing. And then all of a sudden, we find ourselves sitting in the living room looking out the window without that purpose. It is not successful or tenable for most people. You see it in folks that retire from work. My father, for instance, he passed away 4 months after retirement. He never even got his first pension check. That happens so frequently. He was kind of it's kind of an extreme example, but people typically don't thrive if they don't have purpose. So why is this 80% the case? Well, 83% have no written plan. It's not written down. So it's kind of this thing where they think, oh, you know what, I'm going to retire in 5 years. And 5 years from now, it's still 5 years. There's something about putting something in writing that makes it more likely it will happen. You feel more accountable to it. It starts helping you to make decisions aligned with that desire. 54% have no buy-sell agreement. And if you're a business owner that has more than one owner in the business and you don't have a buy-sell agreement, you're at huge risk. If you and I were business partners and we didn't have a buy-sell agreement and I died, guess who your new business partner is? My adult children. And they're wonderful kids, but they would know nothing about our business. They're not in that space. So the buy-sell agreement is something that provides the means to navigate what happens if one partner or the other passes away, and how to pay for the liability of buying out that decedent's shares without bankrupting the company. 49% have done no planning regarding their personal lives. Fewer than 33% know how much they need from the sale to meet their future needs. And only 25% have hired or trained a successor. Roughly 20% have had their business valued, so they have no idea where they're even starting from. As I mentioned before, 10% say they never plan to exit their business. And I'm having a problem with my screen here. Thank you for your patience. 2/3 say they've done no planning because they have no idea what their options are. I mean, it's a very overwhelming thought. You spend a whole career building a business and all of those things that make it work. And then all of a sudden you're facing with, now what? How do I land this spaceship? There are a lot of things to consider, and most people don't know how to figure out what will I need from my business to survive, and they don't even know who to ask. Only 20% are market ready when listed. Consequently, only 20% sell. And then only 1 in 5 have created a written plan, an overall written plan that encompasses their personal, financial, and business readiness. So if only 1 in 5 have a written plan and only 1 in 5 have a successful exit, likely not a coincidence. So my question to you, as it is to all my clients, is your biz leavable? Are you one of the majority? Are you one of the 80% at this point that would not be prepared for a smooth transition to pass the torch to the next generation? So the first thing I would have you look at is where you're at. So about 15% of folks prior to the pandemic at any given time will say that they're ready now. They would sell right now if they knew that they had a buyer that would give them what they needed out of the business. About 30% of folks plan to sell within the next 12 to 18 months. And then 55% are looking at a longer term desire to get out of the business. And this is where I run into a lot of challenges with folks, is when you're looking at wanting to be out in under 18 months, oftentimes there are things that need to happen in the business that just very well may take longer than that. For instance, things like how you, if you expense a lot of things to the business and that drops your taxable income. As a result, since businesses are valued as a multiple of that, every dollar that you deduct could impact the value of your business by $2.50 to $3.50. So oftentimes you need about 3 years of financials that represent your true net cash flow for a bank to be able to look at it and be comfortable with that valuation. So there are some things that can take time to prepare that business for sale. For most folks, again, you're looking at ideally 3 to 5 years, or even longer if it's a family-owned business, to ensure that the business itself is prepared to transition and survive beyond the current owner. Next thing is, are you an A-class or a D-class business? So about 10% of businesses are these low to non-performers. These are businesses that just kind of happen. Folks run the business by the seat of their pants. They really don't have any of their system. They don't have any systems. So they're reinventing the wheel every time they have a transaction. They've not documented anything, so there's no processes for other employees to look at. So every time somebody needs to know something, they're coming to them. They don't do a good job of having financial documentation. So they're just not performing really well in that space. So the bell curve, about 80%, are going to be from slightly above or below average, with the bulk of them being average performers. And then you've got 10% that are going to be best in class. So where do you sit in that range? Well, here's something to give you some perspective. So I have an assessment that I give clients, and everyone who's attending will have access to this at no cost. And it scores. People go through the assessment, ask a lot of questions, answer a lot of questions, and it gives you a score. So every industry values businesses on a particular metric. And there will be a range of multiples that go from fire sale, so basically it's just a liquidation, to a strategic value where a company might buy yours and see a greater value of combining the businesses than the sum of their parts. I had one business I knew of that normally would be in a space that runs at about 2 times earnings. They sold to one of their customers for 10 times earnings, because that customer recognized that the systems that they were running, if applied to their much larger business, would make them a lot more profitable. All of that has to do with what we call the 4 C's, or the 4 types of capital. Those 4 types of capital are what are going to make, about 80 to 90% of the value indication in your business. And those are structural capital. That's your policies, procedures, systems, intellectual property, brand, and goodwill. So it's the who and the how of your business. It's what makes a franchise restaurant attractive to someone who's not been in business before. They buy it, they get an owner's manual that says, if you do this, this will happen. If you're making a cheeseburger, you put this many pickles. They've laid everything out for you. And they've got the law of large numbers of lots of restaurants having that experience to validate how well it works. So for you in your business, as you prepare to exit, making sure that all the stuff that you've got in your head on how you built that successful business is documented. So this would be everything from your employee manuals to policies and procedures, et cetera. Then there's your human capital. That's the right people in the right seats doing the what and the how. Then there's the social capital, which is your culture. This is what's going to indicate how engaged your employees are, how much of an ownership mentality they have. Those who are engaged, feel heard and appreciated, are much more productive. It's about 30% increase in productivity. And also your customer's experience with those employees is going to be much greater. You know, instead of maybe you've seen any number of movies where there's a waitress at a restaurant that seems very unhappy to be there, that versus someone who's very engaging and very positive, it's going to give that customer a much better experience. And then finally, there's your customer capital. And that really is looking at mitigating the risk of highly variable cash flow. So the degree that you close the gaps in those areas of your business, you're reducing risk in those areas, therefore increasing the value of it in the eyes of a potential buyer or a potential bank for your employees, or if you were using an ESOP, the lender that would fund and the trustee that would handle that plan. So if we look at ranges of multiples, and let's just say that you've got a business that has earnings before interest, taxes, depreciation, and amortization, or if you're a smaller business, we'll call it seller's discretionary earnings. Let's say that it's $400,000. Well, at the bottom end of that, scale, at 1x, the business would be worth $400,000. But if you were investing class at the top of that scale of 4x, you'd be worth $1.6 million. Now, that looks at the business having the same earnings. So in other words, you've got two businesses with the same net income and a 400% difference in value. And that 400% difference in value is the secret sauce represented by you as the current owner of that. So one of the things to ensure that you've got a successful transition will be to make sure that not only have you worked with someone to identify and improve those areas of your business, but when you ultimately look to exit that business, that any marketing you do in a sale or any business plan you provide to a lender adequately illustrates those improvements that you've made and why yours is better than, you know, the next ABC company down the road that does the same thing. So personal readiness is just as important as business value. So one of the, this is kind of a list of things that you would look at. Understand the time frame of your exit. There's a few reasons for this. If you say 5 years down the road, it's always 5 years down the road, because if a couple years down the road you still haven't made any progress, you just have in the back of your mind you're going to work a little longer. But if you set that date in stone, figuratively speaking, now you've got a known end date. You've gotten rid of a variable. The reason that's important is because when you have that date for exit, then suddenly all of the decisions you make along the way are going to be aligned with trying to attain that outcome. So for instance, let's say that we go back to you having $1 million need and a $500,000 pool of assets outside the business and needing to net $500,000 from your business. If you knew that you were, and it's worth, you could get $250,000 out of your business right now. If you said to me, well, Michael, I want to exit in 6 years. Well, I know that you would have to increase your business at 12% a year for the next 6 years to achieve that doubling of your value. So now you've got some goalpost by which to actually figure out the financial numbers and whether they're reasonable or not. What they'll also do is help you to look at, well, maybe I can't grow at that rate, but are there any things that I can do to mitigate my tax liability such that at a given price, I can get a higher, net proceeds. It also will help you to ensure that your family and shareholders are well informed. I can give you a tragic example of a client of mine. Was referred to me by a bank. They were needing some insurance coverage for a loan. And in talking with this client, asked about their exit. He and a sibling had inherited the business when their parent passed away. So they already experienced what can happen when there's no plans made. So he and his sibling ran it for 20 years, and an unsolicited offer came for the business. And what was then became my client told his sibling that he would buy her out for half of what the unsolicited offer was, because his son wanted to have the business eventually. The problem was there was no conversation beyond that. They had the discussion at that time. Communication wasn't maintained along the way. Since it wasn't talked about, eventually, son's got to support his family and ultimately is going to have to make other plans as, dad's moving closer and closer more quickly to retirement. And as I'm encouraging to have the conversation with his son to lay out the plans, the expectations, any training schedule we need to have to get him prepared, assessing any shortfalls in skills and talents and experience that the son may have so that we can hire additional talent into the business to support that transition. But it's an uncomfortable conversation, so it's avoided until one day it wasn't. One day the client was diagnosed with stage 4 cancer. So now he's got to do something. So approaches the son no longer wants the business. So now you've got a business that's many years old, is successful, is profitable, and you've got an owner who hopefully can sell it before it becomes clear that he's ill, or before he's unable to continue operating it successfully and maintain its value while attempting to find a buyer. This is a real situation. I have many more examples, and that's one of the reasons that for that 80%. So develop tax strategies 3+ years before exit, because some of it has to do with financing, some of it has to do with potentially tax rules and some arrangements that can be made. Again, I don't give tax advice. This would be something that is a conversation you need to have with your accountant. It ensures that your wealth planners, your accountants, and your other advisors are all well informed for that very reason. If you know that you've got $1 million need and you've got a lower amount of assets put away and you've got a lower value of your business, then in the case where I'm working with my clients as a quarterback of this process, I'm working with the financial advisor to ensure that their investment strategies and our strategy of growing the value of the business work well together, such that at the time frame of the exit, that the financial advisor ensures that they've got, their allocations, and however they do that, appropriately allocated for the client, and have a plan for how to deal with the liquidity event that's going to come from the sale or exit of that business. Likewise, coordinating with the accountant so that they understand that you're not trying to maximize your income any longer, because in doing that, you're dropping the value of your business, so that they know to then work with you to help improve your deduction strategies so that you've got improved net income, therefore improving the value of your business. And then working with the attorney to ensure that any decisions that have to be made with regard to, whether the structure of your business needs to change, whether maybe you need to incorporate, maybe you need to change entity structure altogether, that those things are being done. And then be well planned in case of a sudden exit, and include succession strategies as well as insurance and estate planning. Perfect example is this. You have a person that says, Michael, I've seen the light, I need to do exit and succession planning. That decision in itself does not provide an immediate solution because that's going to take time. So you need to have something in place like a letter of instruction, which I help clients write, that serves as a means to give guidance. I call it the break glass in case of emergency. If I were to pass away, then my children would find this document that states, I'm really sorry to leave this with you. I know you're not in the business. This is one more thing that you have to deal with. Hopefully this helps. These are in my advisors. These are some potential suitors I know who were interested in the business. After my death, this is when the customers should know. This is when employees should know. I want to ensure that income for 12 months following my death continues to flow to my decedents. So it lays out those things that ensure either a way to keep continuity in the business, or at the very least, how to unwind the business over time. It also allows for, in that case, let's say that the owner passes away or a key employee passes away, the company could have coverage that where a death benefit would flow into the business to prop up the business while you're hiring someone to replace that owner or key employee, or as a means to buy out their interest in the business so that the remaining partner now owns 100% of the company. So all of that is planning. It takes discussion. Plan with wealth strategies that will change significantly in the event of retirement as goals change from wealth growth to passive income. Again, that goes to coordinating with the financial advisor. Ensure that you're satisfied with the business legacy. If someone were to tell me that it's important that their business stays in their community, that they want to ensure, or something like, my employees helped me create the opportunity I have for a secure retirement, and I want to ensure that they participate in that wealth that they've helped create, well, that would have you looking more at potentially some type of a stay bonus in the case that you sell it, or maybe some type of profit sharing, or even potentially something like an ESOP, where the retirement plan benefits the employees with some percentage of the growth of the value of the business because they contributed to that. Consider your lifestyle and contingencies such as health as part of the post-exit plan. If we're all, business owners by and large can expect that about 95% of their net worth, unfortunately, resides in their business, because fewer than half have any money in retirement plan assets. And so often they're relying on the net proceeds of their business to fully fund their retirement. If an owner is fortunate enough that they've planned in advance and they've got significant other assets to also rely on, the hope is that we get to retire while we're still in our go-go years. I'm 52. I won't ever truly retire. I'm passionate about what I do. Even right now, sometimes I see myself 16 hours a day just because someone needs help, and particularly during the pandemic. I don't feel like I work. I love what I do. When I was a younger person and in retail, I was ready to go home an hour after I got to work. Totally different circumstance. So I hope to, at age 60, I'm not going to retire, but I want to have the full option of how much I work. That if I don't want to work at all, I want to take 6 months off, I can do that. So I'm positioning myself for that. So for you, it's in the go-go years, those years when you're still young enough to go and travel, you're still young enough to do any of those things, maybe be active in sports or go hiking in the Himalayas, anything that requires you to still have your strength and your cognitive abilities. In your go-go years, it's wonderful if you can do that. Sometimes people have health problems earlier on. So what would the contingency be if, instead of going to hike in the Himalayas, you have a stroke and find yourself needing in-home care for the rest of your life? So it's looking at those items. Also, things like lifetime health care. Folks who work for an employer, particularly in the public sector, sometimes they're going to have, these things available as part of their benefits. But as a self-employed, even though we're 99.5% of the companies in operation in this country, generating over half of the net new jobs, We take all of the risk to do it, and we often don't have the tools and structure in place to ensure that if something happens to us, we're taken care of. Ensure that you have enough income to finance that plan, as we discussed. And then develop strategies to ensure that there is no regret and loss of identity after the exit. So you don't ever want, none of us are going to be on our deathbed saying, I really wish I would have gotten that extra $1 million. But you want to make sure that whatever that thing could be isn't there, that either it's something that you include as part of your plan going forward, or you make peace with the fact that maybe you're beyond that in your stage of life currently. But in any case, you want to make sure that you get rid of any regret, because at the time you have the most control over your life and your future is that moment that you go into business. Because the moment that you're choosing to go into business, you get to design it. You get to pick the kind of business that fits your lifestyle. If you want 100% flexibility of your time, you're not going to buy a restaurant. So you have that control at the beginning to say, I want my life to look like this. And so therefore, this is the kind of business. The time you have the second most control is when you're giving yourself enough time to prepare for your happily ever after. So why should business owners prepare an exit plan? Well, 50% of owners in the US are over the age of 50. And 76% of business owners either can't afford to retire. Hello, can you hear me? Hello? Am I still frozen?
I can hear you.
Okay. 76% of business owners either can't afford to retire or plan to use their business as the primary source of funding for their retirement. Well, it doesn't take a mathematician to know what that looks like when 80% fail to sell and 75% plan to use their business to fund their retirement. That's not a good picture. And between 50% and 90% of a business owner's personal wealth may be tied up in their business, and only 1 in 5 sell or transition. So, the planning needs to happen. And the biggest reason that's not done comes out of fear. It really comes down to that fear of the unknown. And we typically will not go and pursue change until it's less uncomfortable to deal with the change than to stay in the status quo. So if I know that I don't want to think about life insurance because I know that that means I have to die, I've got to think about dying for there to be a benefit. But if I also think about, but if I don't get life insurance and I die, then I leave my family without a means to take care of themselves unless they liquidate what we have. Well, suddenly, if I'm not selfish, I'm going to push past that fear or that discomfort, and I'm just going to address that. The same thing goes with planning for your exit, is to ensure that, you really think about the consequences of not doing it. And likely that negative potential outcome will far outweigh the fear and discomfort of just addressing what you need to do to have a successful outcome. So what happens with exit planning is, I'm going to tell you a secret. Exit planning is just good business strategy. It's starting with the end in mind. It just so happens that if you think of it like a road trip, if I'm going on vacation and I'm here in Northern California and I decide I'm going to go to upstate New York, I know that I'm generally going northeast. So it would stand to reason that I'm going to plan my trip. I'm going to know which highways I'm likely to take. Now, it doesn't mean that I don't decide to go to Maine instead, and I would just have detours, right? It doesn't mean that there wouldn't be some roads washed out along the way and I have to take a detour. I at least have laid out the general idea. I'm going to New York. And most business strategy is kind of looking at it, well, I'm going northeast, but I only know so far that I'm going to Minnesota, right? The rest of it's a big unknown, but I know that, it's going to take me 2 weeks to get to Minnesota on my road trip, and I've left another month. So I have no idea what I'm doing the rest of the time. That's kind of like what it is being in business without an exit plan. So it's just good business strategy. Best example I can give you of businesses that are good at exit planning are startup tech companies looking for investors. And the reason is they're very clear on a couple of things. In their business plan, they know one of the things they need to raise is investor capital. And they know that investors giving them capital are going to care about when they get their money back and how much they're getting. So as a result, that startup business entrepreneur, their business plan and all the decisions they make in it are going to align with that desired outcome. So if you ever hear one of their pitches, they talk about, we want to be acquired by XYZ company in 3 years for X amount of dollars, right? So they have their roadmap. And then they also know that, well, if I'm going after investment capital, I'm probably going to set myself as a C corporation, so I don't have to worry about limitations on the number of shares and some other tax treatments and things of that nature. They're making the decisions based on the outcome desired. And the earlier you do that in the process, the much more incremental and untaxing emotionally and time-wise those adjustments will be. So you'll build a more valuable business as a result. You'll pay less tax and have more accumulated personal wealth as a result, the earlier you start planning. You'll create a better managed business that is more profitable and leads to less stress and better personal health. You'll have less regrets after you exit and more successfully move into a successful life after retirement. Because if you don't know what success looks like, any road will get you there. And then you'll protect your family wealth in the case of an unexpected event like death or disability. So I'm going to go back to number 3. So I'm going to ask a question that normally people would raise their hands. We're not in front of each other right now. But in your mind, raise your hand if your idea of exit planning is the fact that you wish you were out of your business yesterday. You woke up some morning recently and just said, I'm done. And it could be the pandemic, it could be stress related to that. It could be HR. It could be, a regulatory issue or something, but likely let's look at the things that are internal to your business. Now, keeping those things in mind that are causing you to say, I'm done and I want to sell, I want you now to ask yourself, knowing what you know and being in business as long as you have, if you went out into the marketplace to buy a business and saw your business for sale, would you buy it? Knowing what you know about your business, would you buy it? And if those of you who said, I want to sell because I'm frustrated, I'm done, I don't want to do this anymore, if you, on the flip side, say that, yes, you would buy the business, there's a little bit of a disconnect there, because if you're wanting to sell, it means that you don't want to own it, so why would you want to buy it? But it also brings up the question, why would anybody else want to buy it? If it's not a pleasure, if it's not easy for you to run, if it's a demand and a tax on you because it doesn't run out itself, it's heavily reliant on you, things aren't delegated to others who can operate the business. Again, that raises the structural and human capital risk in the mind of a buyer. So one of the benefits under number 3 is that if you run your business like it's for sale, you'll be able to sell it whenever you want, not on a reactionary business basis, not just because, like the client that I had that found out they were ill. It becomes a point where the business effectively runs itself. You own it. It doesn't rely on you. You've done a good job at developing leadership such that they can operate the business. Equally important, you've developed the comfort with letting go of the reins, trusting those that you've hired or the family that you have in the business to take on some risk and fail while it's safe to, because you're still there to run it. You're still there to correct the course if they mess up. So in doing those things, if you run a business that is valuable and sellable, that's leavable, if you will, the great thing is you don't have to sell it. In fact, many folks, once we've gone through a process of identifying those pain points that are causing them duress and frustration and helped work through closing those gaps, they fall in love with their business again. It's kind of like going to relationship therapy. You're ready to give up on that relationship. Well, when you first met that person, you loved them. The moon set, the sun rose and set on them. but over time, things happen, things get neglected, and one day you wake up and you're just done. You go back, you fix those things, and in some cases, those folks resurrect their relationships. Same thing goes with your relationship with your business. So in many cases, when folks find that they've corrected those issues and built a more self-sustainable business where they can take a more passive role, why sell it? They've got an income stream that's almost passive, and they can just collect that dividend and let the people run the business. So now you've got options. So now going to the last one, protect the family wealth in case of unexpected event like death or disability. 1 in 4 people in their 20s will have a long-term disability before retirement. So this is a very real subject. And so the question becomes, for those of you entrepreneurs that don't have any type of income protection, my question would be, if you stopped working today in your business and never answered another question for anybody, A, would the business survive? And B, would your family survive without the income stream for that business? If the answer is no, you need to look at how to protect some level of income for yourself. Because if you are, even if you're participating in state disability, that's only good for 1 year. So looking at all those components. And so ultimately, it's all about the process. We've talked about and unpacked a lot today, and it's one of the reasons that people don't address it because they don't know where to begin. It's overwhelming. Well, there's a process. I'm not going to say it's easy. I'm going to say it's simple. And the process itself is simple, yet it also requires accountability. So it often doesn't work on a DIY basis. Usually it's going to be something where it would be very helpful if you worked with your advisor with SBDC, where you can talk through these issues of where you're at. And maybe it's that they reach out to me if there's some subject matter issues specific to exit. I'm available to give some guidance around that. And that way you can, execute on steps. But you start with the high level goals. And the high level goals are going to look at your business and personal goals. Then you're going to do a value gap analysis to look at, okay, here's my goals. What are the gaps that need to be filled? Then you're going to look at business attractiveness. That's closing the gaps on those operational issues within your business that will make it less attractive, those areas of potential risk. Then you're going to look at personal readiness so you can ensure that you have something to look forward to in leaving the business, because then you're going to be much more energized and engaged in doing those things that help grow and fix the business. Because believe me, when you're looking at fixing and correcting those issues, there's going to be some frustration. So oftentimes that having something to look forward to is going to be kind of the carrot you need. Then there's value creation, and that's what we can do in the business to move you not only up that range of multiples, but also raise the level of net income that's being multiplied to increase the value of your business. And then again, the last thing was the accountability and implementation. Another place where if we were in person, you could raise your hands. How many of you have ever done a business plan or a SWOT analysis? And then the next question is, how many of those ended up in a desk drawer, never to be seen again? And a lot of you may be laughing. It's true. It happens the majority of the time. In fact, 70% of failures within a business in areas that are the owner or executives are responsible for are due to a lack of execution. And only 10% of strategic initiatives identified in SWOT analyses are ever implemented. So it comes down to the fact there is no shortage of good ideas. There's just a shortage of execution. And so with that, working through those things, you're able to create a roadmap to have the best chance of a successful outcome in exiting your business. So there was some market research done by Exit Planning Institute. And these are some of the things that were resulting from people who don't have a plan. 83% of owners have no written transition plan. So that doesn't just mean a sale or exiting ownership to a family owner or anything, or a family member. It could be just transitioning out of the day-to-day operation. There's no plan on how to get the role that you fill and how to get all of the knowledge in your head not to be brain drained out of the business, to be able to replicate that for your staff and those who would succeed you in the business. 93% do not have a formal life after business plan. 40% have no plans in place to cover illness, death, or a forced exit. 50% feel ownership transition plans require the company to remain profitable for plans to be properly executed. Yet 86% have not taken on a strategic review or value enhancement project. Again, another disconnect. Half believe that they have to be profitable, and yet over 3/4, nearly 9 in 10, have done nothing to ensure that that's even a possibility for them. 56% felt that they had a good idea of what their business is worth, yet only 18% have had a formal valuation done in the last 2 years. Good example of this, you can go to a CPA to have your business valued. You can go to someone like the International Business Brokers Association. You can go to certified valuation professionals that they can actually do an appraisal of your business, so you know. But the majority of those who say that they've done a business valuation in the last couple of years, when asked who did it, they said it was themselves or their business partner. Here's the interesting addendum to that. The standard deviation, or in other words, the amount above or below the actual value that comes out of a self-valuation is 60%. So that means in many cases, someone who's valuing their own business that's worth $1 million has an opinion that's worth 1.6 million. So it's no wonder that that business would not be able to sell. They also aren't making adequate plans with that business. If they think it's worth that much, maybe they're not allocating enough in their retirement to make up the gap. So next steps. It's like, Mike, you talk a lot, you talk fast, and this was a lot. So what are some next steps that I can take to at least get me on the right path? The good news is you don't have to remember everything we talked about today. In fact, all you need to remember is that there is a body of information and resources out there for you to be able to attack this in bite-sized, manageable steps. The first is you can read my book. As mentioned, 1 in 2 business owners surveyed have done no exit planning, and 2/3 indicate because they have they don't know where to begin. So I have a free ebook, and Maureen's going to go ahead and put a link to that in the chat box. I made an agreement with SBDC to go ahead and provide that as a resource, and you'll be able to go to my website and download that. It's going to be revised here in the very near future because we're adding employee cooperatives as one means of exit. So, but go ahead and download that when the new revision comes out. That'll be available to you as well. The next thing you'll want to do is to say, okay, well, how do I figure all this out? Like where I'm at, how do I get an idea? If you were to go to my website at bizleavable.com, this is a picture of my homepage. You're going to notice a button down there that says Find Out Now. That's going to take you through an assessment. It's going to ask you a number of questions. You need to be brutally honest with yourself. And they're scored 1 through 6. It's going to force you to answer as a result above or below average. There's a section to the right of that where you can give any narrative that you think will be helpful. That's going to generate an instant score for your business of how attractive it is. What it's also going to do is it's going to notify me of your answers, and I will generate a report that lays out a very high-level view of where a number of your gaps are, prioritized in those areas that represent the most significant gaps to value and sustainability. And third is you can schedule a discovery meeting with me. And basically what happens with that is we set up an appointment and we'll review the results of your assessment. We discuss what an exit plan could look like for you. We look at where you are on the value scale and what you would need to do to maximize its value, what you would need to do from a personal wealth, risk, and tax perspective, and discuss what your goals and personal vision and action plan would be moving forward. I also want to state that this whole presentation, the 3 steps in the end, this is not a sales pitch. is simply all these resources that were mentioned are made available to you at no cost. And so with that, you're going to get some, complementary information that you can take and execute on. If you find that beyond that, you're going to need additional help, then you can be in contact with your SBDC advisor so that we could then discuss what may be the most appropriate road for you to either access some help through them or through me. So I'm glad to be of any help that I can. So with any time that we might have left, I'm glad to be open for any questions that I can answer for you at this time. If they can't be answered now, I'll provide answers through SBDC and they'll get those to you in the future.
Well, Michael, outstanding job.
Thank you.
I'm glad you can hear me. I got thrown out of here for a while, and now I'm back.
Oh, good. Well, hopefully that didn't happen for others.
So I did have a question that was emailed to me, and I don't know while I was struggling to get back in the room if you answered it or not, but I'm going to go ahead and ask it.
Sure.
And the question was, how accurate are industry rules of thumb? Our industry trade group says our business is worth approximately 3.4 times our net profit.
So rule of thumb, there's actually a book that's published roughly annually that gives that. And really what they're looking at in most cases is going to be kind of like real estate. They're comps. So when you look at a home and you go on, you go on the MLS or other platform, you're going to see a price based on a certain dollar per square foot. And that is arrived at through looking at what recent transactions have occurred. Rule of thumb the same way is going to kind of look at what is the range of multiples for that particular industry. What I'll say is that if they give you a rule of thumb in a trade association, that's going to be general because that's across the country. And so the caveat would be that things are different in different states. For instance, if you're in something where there are a lot of, say, environmental impacts from your product, you're going to find it more challenging to address, say, in California than in another state that is more lax in its emission standards. I only mention California because I live here and I'm aware with how they're very good at keeping control of emissions as it relates to auto manufacturers and things. So it's all going to be, there's going to be a general number that's going to be affected by whatever your regional and or local variables that would impact how you're able to operate, if that makes sense.
Sounds great. Fantastic information. Really appreciate you coming on. We're going to make this available to everybody and also your links. We'll follow it up with an email that Maureen does an excellent job on toward the end of this week, sometimes the weekend, but it'll be coming your way. The copy of this, the links, the ebook, and other resources that are available. So much help is needed in this area. Really appreciate you coming on, Michael, and look forward to talking to you about our next steps. So thanks
Wonderful.
Again for joining us.
Thank you so much for attending, everybody. I hope it was of help, and I look forward to being of any service I can in the future. Take care.
So that brings us to a conclusion of webinar number 82. We'll be back next week with number 83, doing the deep dive in the pandemic relief programs. Thanks again to Michael Balstad for joining us. For Michael Balstad, I'm Kelly Bearden. Have a great rest of your week, and we will see you soon. Bye-bye, everybody.
Take care.